Hi folks, Chuck Gibson from Financial Perspectives in Pleasanton, California with July 2016's Charts on the Move. Finally, July brought a pleasant surprise as the U.S. markets put in a move of technical significance. I realize I've been whining and complaining for months on end regarding the 18-month or so sideways consolidation, but July turned the tide. While there's still a number of U.S. indexes well off their historical highs, both the S&P 500 and the broadest measure of the U.S. stock market, VTI, broke out of consolidation onto new highs last month. Interestingly, this came on the back of a large expansion of breadth seen after the Brexit vote sell-off. Let's take a closer look at these charts and see if they're telling us anything now. My first chart, that of a daily look at the S&P 500, shows how that 2120 zone, which had acted as formidable resistance in at least 7 instances in the past, was finally broken. One of the tenets of technical analysis says the more times a level's hit, the higher the probability price will eventually break through that level. Rarely, if ever, have I seen a breakout fail 7 to 8 times as it did in this case. My experience says that if it doesn't do it within 4, 5 times max, it's likely just not going to happen at all. Put this one in the books as a rarity. Quite simply, this breakout combined with a positive sloping moving average is a very bullish event. That former resistance zone now becomes support, and there is no one who is underwater on their S&P 500 investment at this point. There is no supply of sellers waiting to get back to break even and unload their positions. So, you might be thinking, it's time to go all in then, Chuck, right? Load up the boat, so to speak? Well, not so fast. Hopefully by now you know I need confirmation of any move before committing investment capital. In most cases, the confirmation will be done by seeing both an increase in volume and a hold on a back test to the breakout level, neither of which have happened yet. As you can see in the bottom pane, volume on the day of the breakout in cents has been average at best. Ideally, we want to see lots more buyers step in and push prices higher rather than prices moving higher because there are no sellers. Additionally, you can see in the upper pane, momentum is falling, not rising. I have to caution that just because these elements aren't present doesn't mean the market can't go higher, because it can. It's just for an all-in type of opportunity, I need to see all the signs aligned, and at this point, we're just not there. As such, I prefer to scale in and manage the risk of equity exposure by limiting position size. If those missing signals eventually show up, I'm more than happy to add more. The next chart, it's a weekly look at VTI, the U.S. Total Stock Market Index. It too has been trading in a sideways range for close to 2 years and finally broke out above the 107 level in July. RSI momentum in the upper pane is in the bullish zone and it's rising. The breakout occurred as price is above a rising 200-day moving average, which is very constructive and confirms the upward trend and bias. I have to admit, I have some reluctance in becoming wholly bullish given some of the market data underneath the hood. The fact that highs are largely unnoticed against a backdrop of global concern and monetary intervention perhaps indicate the overall oddness of the circumstance. My job is to accept the market and not force my own opinion. Whether you're bearish or bullish, the point remains the same. Markets can surprise. The unexpected can happen and things can change, perhaps even drastically, with short notice, and that fact should not catch anyone by surprise. Word on the street at the end of Q2 was that the cash positions among portfolio managers were at some of the highest levels of the last 2 decades. That's a lot of cash that can be put to work with the market still consolidating along multi-year highs. Dips and corrections are likely to continue to be bought. One U.S. index that has yet to break out to new highs is the past rally leader, the NASDAQ Composite. As you can see, it's still trapped in its 2-year sideways consolidation. We want to see this join the party and break out here soon, as this could act as a propellant to move the broader market much higher and allay much of my tempered bearish concern. My next chart is that of West Texas crude oil pricing. The current fundamentals for oil are abysmal, yet it began a strong rally in early January off an oversold divergent low. The question investors need to wonder is whether the current rally is just an oversold reversion to the mean counter-trend bounce and we head lower, or will oil find support at the 200-day moving average and rally to the next logical resistance near $62? Hopefully, some can see that oil is in the process of forming a very symmetrical inverse head and shoulders pattern. While it's still early and will likely take months to confirm, it's something that I'm watching as it has a very large upside target. If oil prices should move lower, Oil could drag the stock market down with it as they tend to move in lockstep. Following oil, let's take a look at precious metals mining stocks GDX. It's had one heck of a move, and this area being one of critical technical importance, combined with an overbought reading on momentum, leads me to expect we'll see a breather. Normally though, when you have a chart that is this strong, breathers are fleeting, allowing only the quick and nimble to add to their position. Those that blink, miss out. Once any possible consolidation is completed, I expect we see continued strength as the gap above and lack of resistance should allow this to continue its run to the next logical stop at 42, and beyond that, another 10 points higher to 52. This is by far our big winner this year, and because the trend looks to continue, will likely add to the position on any weakness or a break in confirmation above the current $30 zone. Now, let's move on and take a look at the rest of the world using the ETF EFA as our proxy. Quite simply, this chart is absolutely horrid. We're in a confirmed downtrend with lower highs and lower lows, and the potential of a very long-term head and shoulders topping pattern in development. If this pattern were to confirm to the downside, the target is back near the 2008 lows, another 25% lower than it sits today. Until something changes in this chart, it's still screaming, avoid me. Moving over to Asia, not including Japan, using AAXJ as our vehicle, this chart is starting to look constructive. It appears as if it may have found a bottom as a new uptrend has started in January, as it has made a series of higher lows and higher highs. In addition, a nice symmetrical inverse head and shoulders pattern is in development, and while not yet confirmed, it's close. I'm watching this closely as a break above resistance opens the door to an upside target back up to the 2015 highs near $68. I want to close out this month's video with one final chart I've been watching for many months. Like most things, technology can be a major driver towards bigger profits, energy included. But a big piece of the energy sector, which has lagged because technology has yet to catch up, has been the huge potential of its storage. The current favored solution is around lithium-ion batteries. With Elon Musk committing billions to build a gigafactory to make these batteries, I expect it won't be long before we see more technological breakthroughs in the push to decrease cost. Regardless of who wins that battle, lithium will continue to be in huge demand. The chart of LIT, which is the Lithium Producers ETF, is starting to look very interesting to me. After falling more than 60% from its 2011 peak, it formed a divergent oversold low in January. Since then, it has climbed some 50% and sits at a critical support resistance zone. A pullback here to unwind the overbought conditions and allow for a shallow right shoulder would be exactly what the investment gods would be looking for. With a price above a rising 200-day moving average and momentum clearly in the bullish zone, LIT looks like it wants to move higher, maybe much higher. As such, this continues to be on my radar, and with increasing liquidity has the potential for being an interesting holding for long-term investors. Well, that's it for this month. As always, I appreciate your time and your attention and hope you found this video informative and helpful. If you have any special requests for the next installment or comments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening, and until next month, this has been Chuck Gibson from Financial Perspectives with July 2016's Charts on the Move.